Hi, my name is Aman and I'm a CPA practicing in the Metro Vancouver region of British Columbia, Canada. Taxes are on everyone's mind, almost 24/7, since they influence our daily lives. This is why my team and I work very hard to bring you the latest tax tips to reduce your tax burden. In this video, I will talk about trust, which can offer significant tax advantages. Trusts are a powerful tool for tax and financial planning. The main advantage of a trust is that it allows you to separate the control and management of an asset from its ownership. The usefulness of a trust is based on the fact that a trustee can hold the property on behalf of a single beneficiary or a group of beneficiaries for their benefit while maintaining control over the property. Now, there are two main classifications of trust. One is called a testamentary trust, while the other one is called an inter vivos trust. A testamentary trust is a trust created upon death. On the other hand, as the name suggests, inter vivos, where vivos means life, an inter vivos trust is created while you're alive. So either you can create a trust while you are living or on death. Now, you might say, well, Aman, how can I make a trust when I'm dead? Well, it is done usually through a will. You can also do it through a letter from the lawyer that says that I want to create the trust upon my death. But usually it is done through a will that says that upon my death, I want a trust to be created for my 2 kids, etc. And that is how it is done. Now, the classification is important because it is crucial for tax purposes. Some testamentary trusts are classified as graduated estate trust, also called GRE in short form. These trusts are taxed at the same rate as individuals using exactly the same brackets. On the other hand, a trust created while you are alive is all taxed at the highest marginal rate, unless you distribute the funds out of the trust to the beneficiary. This makes sense when you think about it, because if you are allowed to create a trust at the same time you are alive, and the trust would be taxed using the same tax rates as an individual, well, a smart millionaire who is already in the highest tax bracket would transfer money to the trust right away. And suddenly there is a chunk of money that will be taxed at a lower rate, and they could appoint themselves as the beneficiaries of that income. It will be an easy way of not paying taxes or paying less taxes. So that is why government says, well, no, you cannot do that right while you are living. You could still be a beneficiary of that trust, and then you can basically pay fewer taxes than what you should as a beneficiary. Now let's talk about the testamentary trust. When you are setting a testamentary trust, you cannot be the beneficiary. Of course, if you are dead, how can you be the beneficiary? So one of the GRE designation's key benefit is the ability to calculate income taxes payable using the graduated rates available to individuals for up to 36 months after the date of death, rather than having to calculate income taxes payable using the maximum rate on all income. For example, let's say John is very wealthy. A GRE allows him to pass on assets to his children who might already be rich and allow the rich to pay fewer taxes. Let's say if you leave the money in a GRE to a child that is a neurosurgeon making $300,000 a year, if you were to give the money outright to them, it would get taxed at the highest rates. However, if you left the money in a GRE trust and invested that money, the income generated by the trust would be taxed at regular tax rates just like individuals for a certain period of time. This will save a lot of money in taxes. I want to keep this video short and just wanted to explain what is a trust in this video. So I will continue and tell you why people use trust to their advantage in my next video. Thanks for watching this video. If you want to be notified about my new tax updates, please consider subscribing to our YouTube channel.